Dynamic Setups 603, again about the footprint chart, but some more details about it and the combination of high volume and low volume. In footprint charts, you also have high volume areas and low volume areas, and you can use them as trading confirmation because those high volume areas very often tend to be support and resistance. So it's just an area where there is traded more volume or fair prices, but you see them more in detail because you see the fair prices in a candle or in a specific time frame. So many market participants want to trade or have traded over there, and stop losses and take profits can be positioned there. So take profits. If you get here from the top, you can place your take profit before that because it can act as a resistance and it's not 100% sure that this area is going to be accepted again. And if you are long, for example, if you waited for a retest and try to scale here in on the top of that range, you can put your stop loss on the other side. So because this area is going to be very likely to be protected. So in an example, if you have a footprint chart and you see we have a finished auction on top, we have an unfinished auction on the bottom, and we have some high value areas and we have some low value areas, like in this one. You see there's getting less and less volume the closer we are near the extreme. You can use those high volume and low volume areas because a high volume area like this is likely to be tested again in the future. The unfinished auction on the bottom is likely to be taken out and we have a strong high, so you can use this to scale into positions, but the entry of positions you prefer in low volume areas. So in low volume areas like this one, you can see it also in the footprint chart, you can look for short trades and then place your stop loss above a high volume area because that high volume area is most likely going to be, or the likelihood of that area as being protected is higher, and you can look for entries in low volume areas. So you can look for an entry if you would like to scale in short because you want to make a take profit below this unfinished auction or double bottom. Double bottoms are most of the time just short-term reversal signs. They're most of the time not long-term. So at some point they will be tested again and you have a strong high, and then you look for options to scale in short. You can try to scale in short at this area and put your stop loss above the high volume profile, or you can try to scale in here and put your stop loss above the high volume area above. So it is above here. And in an extreme scenario, when you're really risk taker, you can also try to scale in at this low volume area. So it's like the wick of the candle most likely, but you see there is less acceptance that you scale in there and put your stop loss above the high or a couple of ticks above the high. And then you have a very good risk to reward to take out that low. There are also low volume nodes. They can also serve as support and resistance, but we use them mainly as retail traders for entries. Big players very often cannot enter in low volume areas because they need another big player, so they need high volume areas or scale in or out through a long-term period, and there is less liquidity in a low volume area, so we can use it as retail traders. But if big participants are not willing to trade there, which they are not because otherwise it would be a high volume area, we can use this to our advantage. So low volume areas are sometimes often traded through aggressively because the big players are not there, and we can use this as small retail traders for our advantage. So they can be turning points because we are in an extreme and we are looking for further balance, like down here, or the area where there's more volume traded. We want to get back into here, and if we pop up like here, then we can try to short this again. For example, if you don't scale in here aggressively, but you see that we get back and we have a finished auction on top, then you can look for continuing short trades. So we had this example already, but it just applies the same logic as I already explained in the slide before. You try to short in the low volume areas and then protect your stop. You can also shorten the extreme over there and make you have a take profit down here or even further down, and you always protect your positions with stop losses above the high volume areas. So the yellow areas are the one you scale in, and the one in the footprint that we had previously, the high volume areas, are the one where you protect your position, or if there would be a high volume area, also you take profits before that, so before the high volume area is reached. Hope you understood it and you implement it in your trading decisions.